Hey everyone, welcome back to Corporate Decoder. Jackson Real Assets Fund just filed a registration statement amendment, and I am seeing some fascinating details about how they plan to grow. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek into how a unique type of investment fund operates, focusing on real assets and offering limited liquidity to investors. Let's dive into what this means for someone looking to invest. So, we're looking at a filing from July 2026 reflecting a company getting ready for future business. The core of this document is a registration statement, specifically an amendment, which means they're updating information they've previously submitted. Think of it like a company filing a prospectus for their stock. But this one is for a fund that invests in things like real estate and infrastructure. The company we're dissecting today is called Jackson Real Assets Fund. They're registered under a law called the Investment Company Act of 1940, which is pretty standard for investment funds in the US. What is interesting is that they describe themselves as a non-diversified closed-end management investment company, non. Diversified means they can put a lot of their money into a smaller number of investments which can be riskier, but also potentially offer higher rewards. Closed-end means unlike typical mutual funds, you can't just buy or sell shares whenever you want. They offer two types of shares, Class A and Class I. Class A shares usually come with a sales charge or fee, while Class I shares are typically for larger, more sophisticated investors and often have no sales charge. As of this filing, it seems only Class I shares are being offered for purchase. This difference in share classes is common and usually reflects different fee structures and distribution arrangements. The prospectus itself is dated the 20th of July 2026. This is the document that tells potential investors all the important details about the fund. It outlines their goals, how they invest, and the risks involved. Their main goal is to grow your money, known as capital appreciation. Their secondary goal is to also provide some income. This tells us they are aiming for growth, but with an eye on generating returns beyond just stock price increases. Here is where it gets interesting. They plan to invest at least 80% of their total assets in real asset classes. This includes real estate, infrastructure, and natural capital like farmland and timberland. They get exposure to these through investments in private funds, publicly traded real estate companies like REITs, and infrastructure companies. Investing in private funds means they're putting money into investments that aren't traded on public stock exchanges, which can be less liquid but potentially offer unique opportunities. The fund doesn't solely rely on one manager. They use two independent investment managers, called sub-advisors, Cohen and Steers Capital Management and First Sentier Investors. This means a portion of the fund's money is managed by Cohen and Steers, and another portion by First Sentier Investors. Jackson National Asset Management, or JNAM, is the main advisor, overseeing these sub-advisors and deciding how much money goes to each. Think of it like a fund of funds, where different experts manage different parts of the money. Now, they are very clear about the risks. They state there is no guarantee they'll hit their investment goals, and investing comes with a high degree of risk. This is a standard but crucial disclaimer. They really emphasize this throughout the document. Let's look at the pricing for the shares. For Class A shares, there is a public offering price which includes a sales charge. For Class A shares, it is just the current net asset value, or NAV. This means Class A investors pay an upfront fee, typically up to 5.75%. For Class A shares, you buy directly at the fund's calculated value. When you buy Class A shares, the company receives the investment amount minus the sales charge. This is a common way to structure broker compensation. For Class I shares, the full amount invested goes to the fund. This is a key point for an interval fund. Unlike regular mutual funds, you can't just redeem your shares anytime. To offer some liquidity, they conduct quarterly repurchase offers, meaning the fund buys back a portion of its own shares from investors on a limited basis. They expect to repurchase at least 5% of outstanding shares each quarter. Here is a major risk for interval funds. If more shareholders want to sell their shares than the fund can buy back, they might only repurchase shares on a pro rata basis. This means you might not be able to sell all the shares you want to sell, or even any of them, in a given quarter. This limited liquidity is why they stress it is for long. Term investors who can handle risk. They repeatedly mention that shares are speculative and illiquid. This means the value can change a lot, and it can be hard to sell them quickly, especially compared to stocks listed on an exchange. For anyone considering this fund, understanding this lack of liquidity is absolutely crucial. The fund itself is relatively new, with limited operating history. This means there is not a long track record to analyze performance, and like any new venture, it comes with the risks and uncertainties of a developing business. They reiterate their structure, unlisted, closed-end, with liquidity only through those quarterly repurchase offers. They aren't planning to list on any stock exchange, so don't expect a secondary market to pop up for these shares. This section really hammers home the repurchase offers risk. If many shareholders decide to sell at once, it could force the fund to sell its investments faster than it wants, potentially at a bad price. And remember, if the offer is oversubscribed, they'll be buying back shares proportionally, so you might not get to sell all you want. They highlight dependence on their sub-advisors, Cohen and Steers, and First Sentier investors. These managers have significant control over their allocated portions, and the fund's success hinges on their ability to pick good investments. This lack of direct control for the main fund manager over specifics is a risk factor. Then comes a deep dive into specific investment risks. Real estate is a big one, with potential issues like falling property values, rising vacancies, and sensitivity to interest rates. REITs, real estate investment trusts, have their own set of risks tied to property values, interest rates, and economic conditions. Infrastructure companies face risks too, from high interest costs for construction to regulatory changes and operational disruptions. There is a significant risk associated with investing in private funds. These funds aren't regulated like public companies, meaning less protection for investors. Valuing these private investments can also be tricky, relying on estimates from appraisers and fund managers, which can be subjective and may not reflect the true market value. This valuation risk is critical, especially when net asset value is calculated daily. Standard market risks are also mentioned. Stocks can go up and down, markets can be volatile, and temporary defensive positions might reduce potential gains. They discuss tax risk, specifically the importance of qualifying as a regulated investment company, or RIC. To maintain this status, they must meet strict income and distribution requirements. Failing to do so could mean they get taxed like a regular corporation, which would significantly hurt returns. Operational risks, like processing errors or system failures, are a concern for any fund. Being non-diversified also means a downturn in a few key investments could have a bigger impact on the fund's overall performance. Investments in foreign countries come with currency fluctuations, political instability, and potentially less regulated markets, especially in emerging markets where risks are generally higher. Cybersecurity is a modern-day risk for any financial institution. Currency fluctuations can impact foreign investments, and preferred stocks have their own set of risks related to dividends and issuer creditworthiness. Many of these risks are interconnected. Managed portfolio risk is inherent in active management, where bad investment choices can hurt performance. Equity and company-specific risks are standard, and concentration risk is heightened because they are non-diversified. Sector risk is also a factor if they become too focused on one industry. They cover additional risks like master limited partnerships, which have unique tax and governance structures, and securities acquired through Rule 144A or in IPOs, which can be less liquid. Investing in smaller companies also comes with higher volatility and liquidity concerns. Diving deeper into their real asset focus, they detail risks specific to agriculture, farmland, and timberland. These are subject to natural conditions like weather and pests, as well as market prices and government regulations. Utilities also come with specific risks related to regulation and interest rate sensitivity. Let's touch on costs. The main management fee is 1.15% of average daily net assets. The sub-advisors also get paid, with Cohen and Steers getting 0.34% and First Sentier investors getting 0.38%. There is also an administration fee of 0.25%. These fees eat into your returns, so it is important to understand how they add up. The summary of fund expenses table is critical. For classes shares, you see that 5.75% maximum sales load up front, and then annual expenses. Class I shares have no sales load. The total annual operating expenses before fee waivers are 1.88% for Class A and 1.63% for Class I. These fees are significant, especially over the long term. Notice the difference between Class A and Class I expenses. That 0.25% for shareholder servicing fee hits Class A shares, which is typical for different share classes that have different distribution arrangements. The example showing costs on a $1,000 investment is a good way to visualize these fees. Over 10 years, Class A investors could pay around $265 in expenses, while Class I investors would pay around $193, assuming a 5% annual return. It is not a huge difference on $1,000, but compounded over larger amounts and longer periods, it adds up. Looking at the financial highlights for the period ending the 31st of March 2026, Class I shares had a net asset value starting at $10.62, which grew to $11.05. This shows positive growth. Net investment income was 0.20, and net realized and unrealized gains added 0.36, leading to a total gain of 0.56. Per share, the total return was 5.45%. This seems like a solid performance for that period. For the previous period ending the 31st of March 2025, Class I shares started at $10, grew to $10.62 due to a total return of 7.42%. Net investment income was 0.19 and net realized gains added 0.57. This shows consistent positive returns. The investment policies and strategies section elaborates on their 80% policy for real asset investments. Importantly, they state this 80% policy is not a fundamental policy, meaning the Board of Trustees can change it with 60 days. Notice to shareholders. This offers flexibility, but also means the fund's core strategy could shift without a shareholder vote. The JNAM sleeve focuses on private real asset markets, investing in continuously offered private funds that focus on real estate, infrastructure, and natural capital. These private funds can have very long investment lockup periods, meaning your money can be tied up for years. The Cohen and Steers sleeve focuses on publicly traded real estate securities like REITs. They use a mix of top-down economic views and bottom-up valuation models. The first Sentier Investors sleeve invests primarily in publicly traded infrastructure companies, both in the US and internationally. They look for companies with high barriers to entry, predictable cash flows, and sustainable growth. The risk factors section is extensive and crucial. Beyond the general risks, they detail specific ones like limited operating history, the illiquidity due to the closed-end structure and limited repurchase offers, and substantial dependence on the sub-advisors. This dependence on sub-advisors is a significant point. While it brings diverse expertise, it also means the fund's performance relies heavily on external managers who have considerable discretion. Valuing the fund's assets, especially those in private funds, is complex. They use fair value procedures when market quotes aren't readily available, relying on detailed methodologies and independent valuations. For private funds, they often use the NAV provided by the fund itself, which JNAM reviews for reasonableness. This reliance on third-party valuations for a significant portion of assets is a core risk. The tax section is dense, covering how distributions are taxed and the implications of being a regulated investment company, or RIC. It mentions potential issues with foreign taxes and the complexities of investing in certain entities like REITs or holding foreign currency. They strongly advise consulting a tax advisor, which is always a good idea when dealing with investments. They also address investors subject to ERISA Employee Retirement Income Security Act. Because the fund is registered under the 1940 Act, its assets are generally not considered plan assets, which simplifies things for ERISA fiduciaries. Looking at the leadership, there is a mix of interested and independent trustees. Mark D. Nerud is noted as an interested person due to his role with JNAM, the advisor. Independent trustees are crucial for oversight, and their biographies show diverse backgrounds in finance, law, and business. Regarding security ownership by portfolio managers, the tables for JNAM, Cohen, and Steers, and First Sentier Investors generally show none in the ownership categories for the Jackson Real Assets Fund itself. This indicates that the portfolio managers are not heavily invested in the fund they manage, which is not uncommon, but is worth noting. The filing also delves into potential conflicts of interest. This is common in the investment world where advisors might manage other funds or have financial interests that could conflict with the fund they advise. They outline procedures to manage these conflicts like aggregating trades or outsourcing votes. This section details how they handle brokerage and research services. They seek best execution, considering factors like price and broker-dealer relationships. It notes that commissions paid to brokers who provide research services can be higher than those who don't, which is a standard practice, but something investors should be aware of. Now, for my take on Jackson Real Assets Fund, this fund offers exposure to real assets through a managed account structure with sub-advisors, which can be appealing in today's market. However, the closed-end interval fund structure means it is decidedly illiquid. Investors need to be comfortable with potentially not being able to sell their shares when they want, and the quarterly repurchase offers, while providing some liquidity, carry their own risks, especially if oversubscribed. The reliance on sub-advisors and the valuation of private funds are also key risks to monitor. The fees, while not exorbitant, are substantial and will impact long-term returns. It is a fund for those who understand and can tolerate these specific risks in pursuit of potential returns from real assets, and who do not require immediate access to their invested capital. The biggest question for me is how effectively they will manage the liquidity constraints and the valuation of the private fund investments to ensure fairness to all shareholders. That is my take. Stay decoded. If you found this breakdown helpful, please like and subscribe, and check out the Discord link in the description.